Okay, good evening and welcome back everyone to our very special market outlook session here today. Thank you so much for joining me. I hope everyone is staying safe and at home. I know that in the Nordics, there's a different spectrum of how different countries are handling this. And these are difficult times in the market for a lot of investors. The huge amount of volatility may be scary or difficult to navigate. So today, what we really want to do is help show you the market outlook that we currently have based on the research that we're seeing. I will say that given the current market environment, these outlooks many times change very, very frequently based on new data that's coming in. So it's important that we just stay on top of this data. So part of what we want to do here today is, I know many investors are looking at the news, you're looking at different sources of information, and you may be getting a lot of different views. So what we want to do is help synthesize some of that information for you and show you what things we're paying attention to help answer the question whether or not we think that we've reached a market bottom. You know, that's probably the number one question that I've been getting over the last few days, is whether or not we feel that, you know, the market has bottomed and it's time to start buying stocks. There's a few different ways to look at this, so I want to show you some of that research. Again, a lot of different things are coming out. There's still a lot of uncertainties and unknowns to this equation. So I want to show you that research and help you navigate this. So let's go ahead and get started. Before I do, just a quick disclaimer. What I'm going to discuss here today is purely for demonstration purposes and should not be considered as a recommendation to buy or sell any specific securities. So again, this is an event focused more so on the European and Nordic markets. And most of the data that I will show you is more on a global scale, but I will say one of the biggest differences that I'm currently seeing is the fact that Sweden remains open, which is effectively the exact opposite of what most other countries currently are under, including the United States and in New York, where I live. There are over 200 million residents in the United States that have been effectively put on lockdown orders. New York City, where I live, is predominantly on lockdown. And we, at this point, have billions of people around the world that have remained locked down. And what we want to do is we want to take a look at some of the countries that have locked down earlier, that have locked down at a heavier rate, such as China and South Korea. Look at the data coming out of those countries and see how we can apply them to other countries. That's really the top-down approach that we can use to get a sense for what is going to be the impact of this at the end of the day on the global economy. And again, Sweden is one of the few countries, or pretty much the only country right now, that has taken a different approach. And it's going to be very interesting to see whether or not that different approach, number one, still is able to contain the virus, and number two, is able to have a smaller economic slowdown as a result of keeping your economy open. So today what I want to focus on is taking a look at a few different things. I want to take a look at the Chinese data. I want to take a look at the economic and the virus trends. The virus trends are very important for us to understand the length of the economic slowdown. We do now have some early data out of China to get a sense for how deep that economic slowdown is. And also we're starting to get some data as far as what the recovery is going to look like. That's very important. I actually think that the recovery outlook is more important than anything else. And then what we can do is we can take a look at some of the Italian data, which is the second country behind the curve, or the second country that has seen the largest number of cases of coronavirus, and showing that that is somewhat likely to peak right now. So we only have about 5 days worth of data on this, but I think that that's a good trend to look at. And the rest of the world, the US and Europe, are about 1 to 2 weeks behind Italy right now. So the question is whether or not we're going to see those trends continue. And the first 3 bullet points are what I consider the downside risks, right? How big of an impact is this going to have on our local economies and our global economy? On the flip side, we have governments across the world producing both monetary and fiscal policy. In the US, we just created a fiscal package that's almost double the 2008 financial rescue package, which is huge. It is completely unprecedented, similar to the situation that we're currently in. The Riksbank, the Swedish central bank, has approved 500 billion crowns, $51 billion of a QE package, roughly 10% of your GDP, which is also roughly in line with the size in terms of percentage of GDP with the US. So these are massive, massive fiscal policies and monetary policies that we have put in place to try to damper the downside economic effects of the coronavirus. So these are the data points that we're predominantly looking at. So the coronavirus trends are the downside. The fiscal and monetary policy provides some kind of support. And what we're trying to see is whether this all comes out to be a net positive or a net negative. And at the moment, most of the data points to that with the economic data, with the economic stimulus packages, both monetary and fiscal policy, this is still going to be a net negative, right? These policies are not going to necessarily be able to completely negate the effects of coronavirus. And at the end of the day, there are major implications of putting together fiscal policies and increasing the debt of a country by large amounts. Amounts that we have never exceeded before. So those are some of the data points that we're predominantly looking at. Now, when we look at the trends of daily cases of coronavirus, what you're going to see across countries over the next few months are trends that look like this, where the number of new cases grows exponentially up to a certain point, at which point the country has somewhat stemmed it and contained it. And then what you're going to see is this very long tail at the end that determines how long the country needs to remain on lockdown for. Now, if we look at Chinese data, that data predominantly is mostly between the end of, mostly in what we consider February. So if you look at February 1st to February 29th, the vast majority of cases fell within China during February. They just started to institute these regions of China removing some of those lockdowns. So roughly a full 60 days after we saw a substantial growth in cases, they are now starting to reopen their cities. Now, I will say that China is a little different from the perspective of they've had severe lockdowns in place that most other countries cannot do. And countries like Italy, countries like Sweden are not forcing their citizens to do the same. So Italy is really the next case, and they grew out of control for quite some time. And the larger it takes to peak, the longer the tail is. And that's really the concern, is how long is this tail going to take? Meaning, how long is the country going to be effectively slowed down for? Because that's how we can try to model what the economic impact is going to be. Now, Italy has, for roughly 5 days now, started to see a decrease in number of new cases, which is certainly good. However, if we look at cases like in the Nordics, Denmark is still continuing to grow, despite, and Denmark and Sweden, I have these two up because Denmark is taking a very different approach to this than Sweden. Denmark has a complete lockdown. Sweden has a much more relaxed policy at the moment. Restaurants and bars are remaining open, schools are remaining open, young people are allowed to still continue going to work. But as you can see, Sweden had two of its highest days over the last couple of days. And certainly we don't expect Sweden to peak yet, but the question is, with the two differing policies, are we going to see different trends? If we don't see different trends, then I think what we now have is just an understanding that in Sweden's case, that even without a total lockdown, you can still contain the virus, which means that Sweden would see a smaller economic decline than countries like Denmark that do have full lockdowns. So that is the data that we're currently looking at out of the Nordics. That's important for us to keep an eye out on. Now, that's on the virus front. Now let's take a look at the economic impact. And right now only China has enough data for us to even look at to get a sense for what is the economic impact. More importantly, how long will it last for? So there's a few different data points here, and there's some of it is we're looking at high frequency data, meaning data that we can get from other countries relatively frequently and fairly accurately. So if we look at subway passengers, as you can see here, after 60 days, we're still about 50% lower than normal. So a full 60 days later, economic activity is certainly nowhere close to being back to normal. Looking at coal consumption, that has seemed to recover almost 100% back to what we would consider normal levels. So there are different data points that are showing us different things. And I think if we put it all together, what we're seeing is that there's still probably at least a 30 to 40% decline in economic activity a full 60 days later from the start of the lockdown. And these are the data points that we need to give us a better sense of the longer lasting economic impacts. Here in the US, data looks similar to China. In the early days, we're seeing roughly about a 90% decline in subway ridership, in airports, in movie theaters, in passenger traffic. These are all data points that show that at least at this point in the US in a full lockdown, we are seeing similar types of activity as we see in China. So we can use some of those data points to give us a sense for how economic activity is going to slow down. So in the month of, or Q1, we're seeing roughly about a 35% decline in economic activity out of China. And this is the second largest economy in the world. And I think the most concerning part for me is the fact that even though China's potentially out of this crisis, they are seeing that the rest of the world has effectively shut down. So even though their factories are ready to reopen, they're ready to start making things, the rest of the world is completely shut down and is not buying any of those things. And that is the biggest, I think, long tail economic effect that we have here as a coronavirus that is hard to model as to what is going to be the new demand for goods going forward as a result of this. So that's the data that we're currently looking at from a top-down approach. This data has stabilized a little bit in the last week. You know, I've been doing this for a few weeks now, and that data has changed almost every single day. Up until the last week or so, things have started to stabilize a bit. You know, we have Italian data that is showing that they have likely have peaked. US is still about a week to 2 weeks behind. So hopefully we do reach that peak, and hopefully other European countries reach that peak as well. And then we can start measuring the economic impact and get a much better understanding as to, is this the bottom, or is there a much, much longer tail of economic slowdown going forward? Now, the question though is, how do you trade this market, right? So we have that data, but how do we actually trade that market? And I'll just jump over to the OMXS30 real quick. This is the index that tracks the 30 largest stocks in Sweden. We've had a pretty massive decline from that roughly $1,900 level all the way down to $1,250. So far, we've gotten a quick bounce up here to about $1,460. This is a daily chart on the left, and on the right-hand side, I have a 1 hour chart to give you a better sense. Now, as you can see, this was a very quick move to the downside. And the reason I wanted to zoom into the 1 hour chart is I wanted to show you some of the levels that I have been paying attention to. So 1450 was a major level that I had my eye out on, which we're just breaking above right now. So this is certainly a start of a bottoming formation for it to have higher lows. Breaking above a resistance level, this is a starting point of a bottoming formation. The thing I want to point out here is that we do see some pretty major resistance up here around 1500 or so, around a little above 1600, and again here in the 1720 range. So we have a lot of resistance up top. So likely what you're going to see, even if this is a bottom, is a very slow grind up higher, meaning it's going to look something more like this, and we might have still some nasty sell-offs when it hits these types of resistance levels, because you have a lot of buyers that are trapped up here that have bought stocks as things fell. You know, every time the stocks fell, people likely bought. And every time people buy, they're in losing positions that they're trying to get themselves back to break even. So when we get back to those prices, you're likely going to see waves of selling. So that's the data that I'm currently looking at if you're trading this market. So again, we go back to the question is, how do you position for this market? And there's two things that I really want to point you to in terms of research that I think is very important for you to know before you go ahead and pull the trigger on any trades at this point. So on the left-hand side, and this really comes down to two things, correlation and liquidity. These are metrics that any investor should be paying attention to in any type of market sell-off. This obviously is one of the most violent and fast sell-offs we have ever experienced in the history of investing. So but any type of sell-off, these types of metrics are very important to help you inform how should you trade and what should you trade. So on the upper left-hand chart, what I have here is a chart of the S&P 500. This is US data, but the same data applies to pretty much the whole global market. And we use US data because that's where we have the most data from. So and these are all publicly available indices that anyone can access. This is what we call the S&P 500 implied correlation index. And the correlation index tells us how correlated are stocks to each other. So when stocks are not correlated, meaning there's plenty of stocks that are moving higher on any given day, and the same, there are plenty of stocks moving lower on that given day. So they're not correlated to each other. Now, this chart is from basically early February to March. And what you can see here is that correlations normally range in this 30 to 40 range, meaning most stocks are not heavily correlated. So some stocks are moving higher, some stocks are moving lower, and it tends to stay in this 30 to 40% range. But as you can see during our sell-off, that has changed substantially where correlations reached almost 90%. When correlations are at 90%, that basically means that it doesn't matter which stocks you pick. Any stock you pick, if the markets are going down, that stock is going down. If the markets are going up, that stock is going up. And correlations certainly have pulled back a little from the market bottom, but we're still in the 60%. That means that most stocks are still heavily correlated with each other. So what that means is that generally speaking, it doesn't make a lot of sense in these types of market environments to try to pick individual stocks. You're better off trading a broad-based index such as the OMX S30. The second reason that you might want to trade a broad-based index versus individual stocks is purely because of liquidity. Now, what we're looking at here on the bottom chart are the liquidity metrics for SPY, which is our S&P 500 S&P 500 options, which are the most liquid options of pretty much any options in the world. And what you see here is that the bid-ask spreads of options increase from just a little over 0.5% of the spread to almost, you can't see this here, but it pretty much quadrupled to roughly almost, moved up almost fivefold to almost a little over 2% per transaction, which is huge for what we consider the most liquid market in the world. And as you can see, that index, that liquidity metric is very highly correlated to the gray line, which is implied volatility, because as volatility increases, liquidity decreases. So for those very reasons, it's most important that at this point, what you do is you focus on products that give you the most liquidity, and also because of the high correlation, it doesn't make a lot of sense to have to pick individual stocks. You're better off just trading the broader market. So that's really why we point to, when you're trading these types of very volatile markets, whether, and you can have different views, right? Some of you may say that this is a fake bear market rally and we're just going to continue lower, or you think that this is truly the bottom, right? And you think that we're going to now recover back up to the levels that I had specified before. Regardless of which one of your views are right now, you're better off expressing that view using a broad-based index like the OMX S30 rather than doing it through individual stocks, just because most individual stocks right now are very heavily correlated to the index itself. So what this brings us back to is the OMX S30. And what I want to leave you with is an example of how do you position yourself utilizing options for either direction, either a bounce higher or a move lower. So for the example that I'm going to give you, I'm going to use a bullish example, right? I'm just going to say, let's just say for a second right now that we believe that this is a market bottom, and you think that the markets are going to recover and move substantially higher over the next few months. So what I want to do is I want to show you some strategies that you can use to play that. So the strategy to use when you have such high volatility, where buying a call option or buying a put option is extremely expensive, is to do two things. Number one, what you want to do is when you're buying, you want to go further out in time. And I know that means that the call options are more expensive, but what you want to do is you want to negate some of that high volatility by selling very, very short dated options against it. So what you can do is you can sell short dated options in the current market to offset the cost of buying that long call. So you can use different options to do this, but what I have here is I have different views where you can buy, let's say a June, let's say I'm looking at a 1450, I'm buying a June 1450 option, so an option that's just a little bit in the money. And then what you want to do is you want to sell very, very short dated options against it to offset the cost of buying that very high option. And here I have a screenshot of a previous example that I had up. Now this was taken about a couple of hours ago when the OMX index was trading at 1440, but the example is the same. You can always shift the strike price is higher. But what at the time when it was trading at 1440, what I was doing is I was going out to June, which is 84 days away, and I was buying a 1420 call option, which costs about 105 crowns. And what I was doing is I was selling a very short dated option against it. So in that particular case at the time, I was selling the 1450 call. Here you might sell a slightly higher call, a 1470, 1480 call. And what you want to do is you want to collect a decent percentage of the long call in a very short amount of time. So here I'm selling the March 27th, which expires tomorrow. So just in a single day, in this particular case, I was collecting roughly 12 crowns. Again, you're going to have to adjust these accordingly. You know, the markets are now closed, so by tomorrow you might not be able to sell the March 27th. You might have to sell the April 3rds. But the idea is that each week, and each step of these is just a week out. Each week, what you want to do is you want to chip away at the cost of buying this 105 crown call option by collecting, you know, in this particular case, I was collecting 12 crowns tomorrow. So I might sell the 1450s. And as long as the index stayed below 1450, I collected 12 crowns. If the following week, if the markets move higher, I might sell a higher strike price. So I might sell the 1500s the next week, and the week after I might sell the 1550s the next week. But what you need to do is you need to adjust these strike prices based on each individual week, based on each individual week, and try to collect a portion of the cost of this long call. In this particular example, if I'm able to collect 12 crowns, 20 crowns, and 20 crowns for each week, then here I've basically reduced the cost of this call option by roughly a half, because 20 plus 20 plus 12 is 52 crowns, which is roughly half of the cost of this June option. So by April 8th, which is still giving me plenty of time before expiration, I've reduced the call option, the price of this call option from 105 crowns to roughly 52, 53 crowns or so. Now, this does require active management, but in this type of fast-moving market, you have to pay attention every single week. You can't just buy an option and hold on to it and hope that you're going to make money. You have to be very diligent in staying on top of the research, like the ones that I'm showing you here today, but also at the same time, staying on top of your positions. Now, in this particular example, what you have to do is you have to select strike prices that by next Friday. So let's look at April 3rd real quick, because it might be a little too late for you to sell a 1 week option now that the markets are closed. But if we go back to our chart I had expressed that 1520 or so is a pretty major resistance level here. So maybe next week what you might want to do is sell maybe the 1520s, which, as you can see here, collects roughly 12 crowns, or here about 14 crowns or so, 15 crowns or so. Now, buying that June 1450 call will cost you 85 crowns, but I'm chipping away almost a fifth of that, 15 crowns, in just a single week. So as long as I can identify levels that I think the market will stay below, then I can collect these 15 crowns a week. If the market does go above 1520, what you're going to have to do is you're going to have to buy back these calls if you want to maintain your long call exposure. But you might be able to buy it back for maybe 4 or 5 crowns instead of the 14 crowns. So you still make maybe 10 crowns that week to offset the 85 crowns that you're paying for that long call option. So that's how you would utilize this to take potentially a longer term bullish view, meaning you think that this is a market bottom, it's going to continue to recover. Or you can switch these to puts if you think that this is a that you think that the markets are still going to move lower. So puts, you would just have to sell a lower strike put option against it. So buying a June 1450 put will cost you 114 crowns. You'd have to go back to your chart and say, well, how far do I think the market can go in the next week in terms of to the downside? Maybe around 1340, 1350 or so. So as you can see, it'll cost you 114 crowns to buy a 1450 put. And then you can sell a 1 week 1340 put against it for 22 crowns, which offsets, again, about 20% of the cost of that long call. So you're offsetting 20% of the cost in 1 week. So what you want to do is, if that week expires worthless, you keep your 22 crowns, you sell the next week. You might adjust your strike prices again based on where the market is trading at that time. And you continuously do this until you chip away at the cost of that long put down to a reasonable price, because 114 crowns to pay for a 3-month option is a large amount of money to pay. You're paying almost 7-8% of the index value to buy that 3-month put. So that's how you go about positioning yourself, utilizing the high volatility of this market, because that's really what you're doing here is you're selling extremely high volatility, because these April 3rd, April 8th options are trading at very, very high volatilities, and you're taking advantage of that, and you're using the volatility to your advantage. And that's you can only do that utilizing options. You can't do that utilizing stocks. So you can take the longer term bullish or bearish view by buying either the long term call or put, and then continuously sell 1 week options against it, sell that extremely high volatility to offset the cost of buying that long term bullish or bearish view. The only thing I will say is that you might have a, let's say, long term bullish view today. That might change very drastically next week, because maybe we get new data that comes out. Maybe we find out that Swedish system of keeping things open is not the right strategy, and they start to lock things down. If that's the case, you might want to flip your strategy to a bearish strategy. Whatever that is, just make sure that you stay on top of your positions, stay on top of the research, because things are moving very, very quickly. And lastly, I just hope that you guys are all staying safe. So thank you so much for joining me today on this market overview. We are doing this every single week for you guys here in the Nordic market. So I will be back next Thursday, same time, 5:30 p.m. Stockholm time, to update you on the economic research, update you on coronavirus trends. Hopefully we have some better data to show you that has further evidence that this is a market bottom here. I hope that is the case, but again, things are moving very quickly. It is possible that things shift to the downside. So we want to help you stay on top of the markets. We want to help you understand how to position this. And I hope that this was useful for you guys to do that. If you have any questions, I have a few minutes to answer some questions here. I know there's a couple of questions ready here in the chat window. So please pull up your chat window if you have any questions around any of the data that I showed you here today. So Stephen's saying, if you let the March or April expire worthless, means no need to close to sell the position, just let it expire and keep the credit, correct? And the answer is yes, Stephen. If this April 3rd, 1340 put expires worthless, meaning by April 3rd, the index is above 1340, you don't have to do anything. You will keep the 22 crowns, and what you want to do is you want to look to the next week and sell another put and continuously chip away at the cost of that 114.6 crown put option that you've purchased. So I hope that answered your question, Stephen. Ashok is asking a great question. Fees, won't they eat through the winnings? Absolutely. Fees will eat away into your cost of your trade. So that is something you still have to factor in. I unfortunately don't know how much you're paying for your commissions or your fees. So that is something you have to factor into your trading. I will say that if your fees are very high, what you can do is, the only thing that you can do if your fees are really high is, instead of selling 1 week options, you might want to sell 2 week options. So for example, if you sell a 2 week, maybe a 1325, 1330, or 1340. So at 1340, you're collecting 31 crowns. So that's the only way to offset high fees. Obviously, when you're trading options this actively, you want to try to find the lowest cost provider on that front. But if you have very high fees, the best thing to do is just to sell longer dated options. Maybe instead of selling 2 week options, you might even want to sell 3 week options. And it obviously takes a little bit more work, because you have to then project out 3 weeks where you think the markets will be, and what level you think the markets are going to stay on top of. Maybe you move your strikes a little lower, but you're collecting, let's say in this particular case, 34 crowns, 35 crowns in 3 weeks, as opposed to 22 crowns in roughly 1 week. So that's the only way to offset high fees. Any other questions? Well, if short-term trades are failing versus a long-term one, am I holding for bearish scenario for long-term, but the road there is sideways? Ashok, I'm not sure I understand your question. In a sideways action, this strategy makes a lot of sense, right? Especially in a short-term, slightly neutral view, because these puts will expire worthless, which will offset the cost of that long put. So, but you wouldn't take on this trade if you didn't have a long-term bearish view on the markets. You should not trade anything like this if you just think the markets are going to move sideways. This is obviously not a good strategy if you think the markets are going to move sideways. Is it better to keep the long strike price within 1 standard deviation? The longer dated strike price should always be near the money. So the current price is 1470. So I would always buy an option that's near the money. You want to sell something that's about 1 standard deviation away, Stephen. Do you have any debit strategy if we think the market will go down? You certainly can trade a debit spread. That's the default strategy that we show you here if you select I'm bearish. So this is buying the 1430 put going out to May, selling the 1200 put against it. You can go a little further out in time if you want to, but that's the default strategy that OptionsPlay will actually show you. Anit, if you look at the initial message that I had, we'll be covering US markets on a different session, so please join us for that. This event is focused here on the European and Nordic markets. So with that, I just want to thank everyone for taking the time out here this evening. I hope that this was useful. Like I said, because of the current volatile conditions, we are going to be doing this every single week for you guys, every Thursday at 5:30 p.m. Stockholm time, to keep you guys updated on the research and making sure if any new developments, changes in the options market, helping you understand how to go about navigating that. So with that, thank you so much. We'll send out the recording to everyone here in a few minutes to make sure that you guys all have access to this and you can review at your own time. So thank you so much, and I hope you guys have a great evening, and I'll see you next Thursday.